strategies, that is call spread and put spread, which are very, very simple, easy to understand with a better risk to reward. Plus that adjustment part you will get to know only when you are jumping into the options. So while that you have taken a position, the position is going into loss, then you can take my suggestion like how the position has to be altered. Even otherwise, if you leave the position just like that till the expiry, keep on creating bull call spread because market has to rise every year on an average of 14-15%. So call spread will give you better profits. So just keep on creating the call spread either on index or on stocks every month after month, blindly, every month after month. You will see that 60% minimum your trades are going to be profitable. 40%
Sir,
loss making trade.
sorry to disturb you, sir. Sir,
Yes.
is the recording started?
Yeah, started.
Thank you, sir.
So 60% of the trades are going to be in profit, 40% of the trades approximately will be in loss when you take lot of trades into account. So overall your performance when you see, you will be losing 1 rupee 40 times, but you'll be gaining 2 rupees 60 times. That's how it is going to create an edge for you. Whether you believe it or not, in the game of tossing a coin, the probability is 50% that you would win. If by any chance the probability becomes 55%, you can make a killing amount. That means just 5% extra probability in our favor and we can do wonders with our money. I'm telling you here, the risk reward is also double. For every rupee risk, you are going to get 2 rupees reward. At the same time, the odds are in your favor. So, for beginners, just keep on doing call spread. Whether you get loss or you get profit, like a computerized system with zero emotions, keep on dealing with option, option, option. Only call spread and forget, no adjustment required. Do this for 2 years and then show me the report. You would be in profit. Loss would come only when you become emotional and you keep on altering your position. In every trade you are aiming to make profit. That is where you may mistake. So do not commit that mistake. Alright. Now coming with the final strategy, that is the calendar spreads. In calendar spread, we create bull or bear call and put spreads, but on different expiries. Example, Nifty sell 18,400, call expiry of 17th November. Let me take the premiums also here. Okay, first note it down, then I'm sure. Alright, so calendar spread. In calendar spread, what we do is we only create bull and bear call spread and put spread. So we have already discussed about the bull call spread and the bear put spread, then bear call spread and the bull put spread. In case you are confused, you will have to go back and check those 4 strategies when we started with the beginning of hedging trades. So rather than doing on the same strike price, we can also do it on a different expiry. Sorry, rather than doing on the same expiry, we can do it on a different expiry, not same strike price. Strike prices are different in spreads. So what we'll do, let's say that I feel that market is going to rise in the coming few days. Market is going to rise in the coming few days. So what I have to do? I must buy a call, I must sell a call. So I am going to buy a call of the next few days. That means the next expiry is on 24th November. 18,400 call expiry. Let's see what is the price. Firstly, we'll see the 17th November, 18,400. Call expiry is available at 53. So I'm taking a round figure. Sold at 50. And buy 18,400 call expiry of 14th November at 160. Now what is the advantage of this? Let us discuss. Today is going to be an expiry because today is 17th November. Tomorrow we are going to review this trade once this is over. So this is likely to become 0. Okay, this is likely to become 0. So if Nifty is expiring today around 18,400, what is Nifty right now? 18,410. That means if it is expiring at the same level, let's say, there hasn't been a big rise or there hasn't been a big fall, it is expiring where it closed yesterday. So what will happen ideally to the call premium? They will neither reduce big nor they will rise big. But because the time value one day got over, maybe this will become 140. 20 points will be down. Why? Because one day is now cut short. The chances are reducing. That is why. That is the time value. All the OTM options will have the entire premium as a time value only. That premium will keep on getting eroded. And on the time of expiry, it will become 0. All the OTM options will become 0 on the time of expiry, which we are going to review tomorrow when we start the session. But you will see that in case Nifty is expiring around 18,400 level, then this is likely to give us a loss of 20 points. But what will happen here? This will also become 0. Here we are going to gain 50 points. So 30 points loss, 20 points loss plus 50 points gain is overall 30 points of profit. With this 30 points of profit, you can either exit the position altogether. Otherwise, this leg will get over today. You can add a leg here. You can sell 18,500 call expiry of 24th November itself. This is your regular call spread. Advantage would be that you have got already a benefit of 30 points here. So your risk reward will improve further from 1:2, it will go to like 1:2.5, 1:2.7. Hope you are getting the point. This you will only get to know after today's expiry. So tomorrow only I will be able to explain you these values. But keep this contract in mind. Alright, so this we are buying it at 160. So what would happen to this trade? Tomorrow only we'll be able to see. What is the view? Today, view is that today market will remain stable, but tomorrow onwards it may rise gradually. This is my view for the market, that today it may remain stable, but from tomorrow it is going to rise gradually. Then I would do this. And exactly opposite you can do it for put. Unfortunately, I cannot give the profit loss report right now because we do not know what would happen to this premium when this is becoming 0 or when this is becoming 70 or when this is becoming 100. That tomorrow we'll be able to compute the profit loss report for this. Because we cannot just, this one we know what is going to be the price at various points. But this one, how will you know? Because it's not yet expired. Na? On 24th November only it would expire. So what happens to this value after today's expiry? Tomorrow we'll be able to review it. Then the picture will be better. It will be more clear to you. Alright? And now coming to a very important topic. On index options, because this option is there for us, there is a chance that we can make once in a while, not every time, once in a while, maybe once in a year or once in 2 years, you will be able to make amazing returns with an option hedged strategy if you are able to predict the market fall. See, one is a market cycle where a big fall is expected. That opportunity will come to you once in approximately 15-20 years. We should definitely utilize that opportunity. But apart from that, time to time, every 6 months or once in a year on an average, you get a big fall in the market wherein you can expect 10, 15, 20% fall in the index. How can we predict those falls? And how do we capitalize on it is what we are going to discuss now. So during this market fall, how can you hedge your portfolio? If you are already having some portfolio, there are quality stocks, you want to retain it because you see that the fundamentals of the company are very strong, you do not see the price falling down big, then keeping your portfolio as it is, how you can take insurance over it, that's point number 1. And apart from that, how you could make excess income even though market is falling. But before that, our study should be, how do we predict these falls? Very important topic and very interesting. I like to review these slides time and again. So I have got slides for predicting market falls and crash. This is all the crash which we have already discussed. How the scenario for the crash is built up. We have done even the exercise and all. But this is an important thing to notice, guys. Very, very important point to notice. I'll give you 2 minutes of time. Forget on the right side, only focus here and tell me what is that special thing, unique thing that you find in this particular table. Okay, this particular area what I'm circling, what is so typical about it? I'll give you 2 minutes of time and post your answers in the chat window. Let's see test your observation. Alright, so time up. Let's see what have you observed. Any answers that I've got in the chat window? Every year in the last quarter, market is PE peak. Do we need to call spread every day? Okay, that's a different question. Don't have to do call spread every day. It is every expiry, Praveen. We have weekly expiry on index. We have got monthly expiry on stocks. So if you are doing on stocks, you'll have to do it once every month. If you are doing on index, you'll have to do once every week. Every year in the last quarter, market is in PE peak. Okay. Can't say just last quarter. If you see, we have March month also. We have got February, January. First quarter is also here. And it is a half year because we have got correction even in the month of October, December. So carefully, if you observe this table, markets have historically corrected from the top in the months of October till March. Very important point to notice. Big falls in the markets have come only between October to March. October, November, December, January, February, March. These 6 months are very, very crucial. Now, why it is so, no one knows it. There is no answer for it. But it has been the trend so far. There is no logic behind it. Maybe that in America, company keeps posting the results, and for them it is January to December. So year-end results may be bad. That's why you get most of the falls during the month of December. There are a number of reasons that you can give, but numbers theory is what we can make out only through the data, and data says this. And majorly the falls have come in the month of December only. See how many falls we have got in the month of October first. So 1, 2, only 2 falls. Interestingly, there has been no fall in the month of November. That's why I am not at all bearish in this month. I am confidently creating the rising market strategies in my account for this November month. That means confidently I am able to sell the puts. Because never the market has corrected in the month of November, even if you are considering these 6 months. Again, why? There's no answer for it, but trends have been like that. And doesn't mean that it will never happen. Next time it may be November itself. Next time it may be the other 6 months. We are only playing on the probability theory. We are not going to take any trade just on the basis of this data. There are other things also that we will be checking in. But at least this one signal you get that if you want to be bullish about the market or if you want to be bearish about the market, then definitely this table would help you to take a better decision. So we have got 2 falls in the month of October, we have got 0 falls in the month of November, then December we have got major falls 1, 2, 3, 4, 5. 5 falls we have got in the month of this. These are all major falls, not 5-10% fall. Fall like 20, 30, 40% on index. That kind of fall. Amazing big fall. Minimum 10%. Imagine Nifty going down by 2000 points. That kind of fall I'm talking about. So we have got 5 falls in the month of December, and then in January we have got only 1. So January is also not a great month for the markets to collapse. Then February we have got 1, 2 and 3. So February also seems to be a dangerous month. Then coming to the month of March, 1, 2, only 2 falls. This is a very, very important data for us to create a bearish strategy by doing a hedge trade. Not just purely on this basis. If this is coinciding with our other reading, we are going to see more readings now. So those readings are also saying, yes sir, it is time for the market fall. At the same time, the months are also in this. Then we can confidently take some bearish strategy. Remember at the start of the session when I started your batch, I told you that till March market looks little uncertain. I said that till March it looks like markets may fall or markets are little risky or the stocks may collapse. So any fresh investment would only be advisable after March. So not just purely on this basis, the other things also we will check. So based on that I say it. But that fall is going to be a buying opportunity because we are in the last 2 phases of the market where a huge rise can be expected. We are only predicting a small fall and a fast recovery over it. So during that fall, we should with guts enter into the market. We should buy stocks. We shouldn't sell it. Alright. So now write down. Very, very valuable notes. This is all read. I have gone through the historical data, every marking point I have checked it, compared it with the P ratio, not just Indian market, even global markets. First important data that we notice is so December 5, then we have October 1, 2 falls in October. February has been 3 falls. March 1, 2. January has only been once. So mainly December and February are dangerous months. Very, very important note, guys. And I suggest you to keep on reading your notes at least once in 3 months. These all points have to fix in your brain till your last breath. Because in market there is entry, there is no exit. That's how the veterans say, the big investors say. When you start investing into the market, you will only think about adding more and more money if you are doing good. So this journey will continue for your lifelong, just like real estate. You keep on buying properties, selling properties for your lifelong. That is how your investment towards the market would be. So each of these data points is very, very important for you. This will help you to prepare mentally what can be expected in the market. Otherwise, people are playing blind. Retailers don't have this knowledge. You may not find this knowledge even in other books. This is my personal reading. Half of the content what I'm giving you is my personal reading and half is through the books that I've got the knowledge. So if you are just thorough with the notes that I'm giving you, you do not have to read anything in the market, no book, no newspaper, no media, just absolutely nothing. Only follow the notes and follow that, whatever that I'm saying. Only when you jump into it, you'll realize, yeah, this knowledge is more than sufficient and is going to help you till your lifelong. There's another interesting topic called as VIX. These are all like not required. How the markets fell down, how when did they recover. So every time that the market falls, it does recover. And this is a very, very important chart for us. I love to read this VIX. Underrated by most of the people, but overrated by me. Just amazing. What is it? Let's understand. Please note down each of this point. Very, very important. Write it down. Okay, so let us understand what is this VIX. VIX also called as volatility index. That's a full form of VIX. Volatility index. Exchange. That's your X. So in simple words, it is nothing but the fear meter. When the markets are taking high tides, big swings, the VIX rises. When the markets are stable, small swings, small tides, the VIX reduces. This has been a cycle for the market that it goes to high VIX, it stays there for few days, few weeks, comes back to the bottom. Again after a few months, it will go with the big spike will come. Again it will reduce. Again a spike will come, it will reduce. Meaning 80% of the time the VIX is going to trade in normal range only of anywhere between 10 to 15. 80% of the time. But at times sudden spikes will come in the VIX, which are nothing but the market falls. The chart of VIX is exactly opposite to Nifty. Nifty is increasing, VIX reduces because the fear reduces. Nifty is falling, the VIX spikes because the fear sets in. So understand, the VIX chart is exactly opposite to the Nifty chart or the market chart or the stocks chart. So whenever the VIX is high, you can be sure that the market is collapsing, the market is falling big. Average VIX has been around 18. How 18? Most of the time it stays in 10 to 15, but sudden big spikes will come where the VIX will shoot up to 25, 30, 40 also. Like that average comes to 18. So whenever you see VIX is below 18, you can be sure that now markets are going in a smooth range. Accordingly, you have to create the option strategies also. Huh? So right now the VIX is how much? Let's see, around 14. So market, that's why you are very stable. You are not finding big movement in the market, 15 is the VIX right now. But look at the spikes. I told you, time to time the spikes will come in the VIX. They generally trade lower only. But these all spikes are nothing but the market falls. Here markets fell down, here markets fell down, here markets fell down, here market falls down, here market falls down. This was your corona time. So this kind of big spike maybe we'll never see again in our lifelong. So this again has been a market fall. There's a market fall. So we do not have the data beyond this because in India it only got introduced in the year 2010. Alright. So all these spikes are nothing but the big market fall. How could we predict such kind of spikes to come again in future? Like we had a recent spike in the month of March where VIX shot up to 28. So that was in the start of the March. So I can take the March full month into account. March, April, May, June, July, August, September, October, November. It has already been 9 months, but we haven't got spike in the VIX. So what should you expect? Sooner a spike should come like this. To say it looks very, very small, right? The spike may look as very small to you, but this can hit your portfolio by 20-30%, Your 1 lakh may become 70,000, 80,000 in these small spikes that you are seeing. This is on a daily basis. This is the weekly chart. So always check the weekly chart. I'll tell you why. So we have had a recent spike in the month of March, and already there have been 9 months that we haven't seen a big spike in the VIX. VIX has been falling since then. Okay. So one thing that we are observing right now is that since 9 months, sir, VIX has been falling. So sooner, 9 months is big number, even 6 months also you have to be alert. Because it is in the month of November, I would say that, okay, we are in a safe zone because never the markets have corrected. But now there are 2 readings which are coinciding, guys. One is we know that December month is very dangerous, and December to March anytime we could expect a market fall. And we haven't got a fall in the last 9 months. According to the VIX data also, we have continuously been descending since the month of March. Two data points are suggesting this. Let's see further. VIX is a volatility meter that rises when the market falls and peaks out when the market crashes. It keeps falling with the stable to gradually rising market. The value indicates the market expected range in the coming year. It was introduced in the year 2008. Alright. It signifies what the traders are expecting in the market movement in the near term. Taking contrary view to this, low risk, high reward. Okay. So what you'll have to do, whenever you see that the VIX is continuously collapsing and it has been a long time, like 6 months, 9 months, 10 months and all, you have to think reverse. You should be able to judge that sooner the market is able to fall. Maybe December month can be dangerous month for the market. Let's see. Let's observe. The mean value is 18 while the minimum value is around 10 and the maximum several peaks have happened at 70, 60, 40, 30, though they do not sustain there for a longer time. That's why I tell you that though the market may fall, it is going to be a buying opportunity because from there it will recover quickly. Only when it recovers quickly, you will see that VIX is not sustaining. That is why that spikes you will see. What does those spikes signify? That falls do not sustain for a long time. Alright? Most of the time, when the market rises considerably for a long time without any major correction and VIX trades in a lower band of 10 to 15 for few months, that is 5 to 8 months, correction is in the offing as under such condition market becomes very sensitive to bad news globally. Very, very important data point to be noted. Write it down please. So one point that we have observed is that October to March is anyway dangerous month. Second point, so 2 points we have got to know. Month of October till March is anyway dangerous. Second point we'll see is the VIX. It has been continuously falling since 5 to 8 months. Yes. And then markets have not fallen big in the last 5 to 8 months. Yes. So we are mentally getting prepared that okay, the next 4-5 months looks to be very much dangerous. Maybe that we are trading in those crucial months and the VIX is also trading lower and lower. The market is rising and no correction is happening. This can also happen. We are only playing on probability game. It doesn't matter. Let market rise, but always be prepared for safety. Maybe till March month market may go to 19,500 also. Doesn't matter, you may not have gained that rise. There are always stocks available cheap. We are going to buy those stocks which haven't yet risen. But at least we know that there can be a high tide. See, just like saying the weather forecast says that it can rain. The weather forecast says that it can rain and you are going out on bike. What will you do? You will carry a jacket. Does it mean that it will surely rain? No. Then why are you carrying the jacket? There are chances. So this is like an umbrella. This is like a rain jacket for you and you are mentally being prepared that okay, I know that it can rain and I am protected. If it doesn't rain, no problem. We aren't losing anything. Let's say market doesn't correct, market is rather rising. No problem. Maybe we did not buy stocks, maybe we did not participate in the market rise, maybe we did not gain from the market rise, but we even haven't lost. And even though market rises at 10,000 Nifty also there were quality stocks available, even at 15,000 it would be available, even at 20,000 it will be available, even at 30,000 it will be available. There are 7,000 companies, guys. Definitely you will be finding some companies which are fundamentally strong and are yet trading cheaper, and if you do not find it, then we are in euphoria. Then it's always better to get out of the market because nothing is available cheap, and that is where the market big crashes come. That scenario will come after 3, 4, 5 years, but not now. Things look dangerous, be prepared. Let us take a defense. So it's not time. That's why whoever is deploying funds, I am suggesting only the companies where the price has fallen big. All the companies what I've suggested you during the training are the ones where the prices have already fallen. Those are safer. That means even though the market falls big, they will not. And if market is stable or rises, they will rise big. So I've already told you about the sovereign diamonds. So if you see, the price is now trading at lifetime high. So that is how the studying is going to be useful for you. See Nifty was flattish. In the last 5 days, Nifty has not given you great returns. But look at this stock, it has now touched the lifetime high. Alright. So your portfolio is already rising, though the market is not rising. Previous high was 18.3 and now it is 20 already. I am expecting more rise to come. Let's see when it comes. No matter what, market always oscillates or moves in waves. So the VIX, however good or bad the news flow could be, it cannot sustain in a band for a long time. Again, a very important thing. VIX is like a spring, guys. You can compress the spring and you can hold it for some time. But if you release it, again it will expand. VIX is also like this rubber band or like this spring. It cannot remain compressed for a long time. So that means when you are seeing the VIX is continuously falling or the VIX is trading in 10 to 15 band for a very long time, it cannot sustain there for a long time. It has to expand. That is the nature of the market. Otherwise the entire public will make money. That has never happened. Someone has to lose, right? And most of the time it is the public which loses. And this public opinion is only what VIX is. So when I see that the VIX is reducing, it means that the public is not expecting the markets to fall. But when I see the VIX is rising, it means that the public is getting panic. When they panic, we have to buy. When they are confident, we have to sell. We should do exactly opposite to what our friends are doing. What our type of investors are doing. We should do exactly opposite to them. Then only you will be in that 10% elite club. Now this is all the historical data that we have gone through and observed it, how the VIX has behaved and how the fall has come. So this is not necessary. Through notes, if you want, you can read that. This is just to build confidence in you that yes, compressed VIX is always a good signal to predict the market fall. Drawdowns and other readings are computed on weekly charts and daily book market. Okay, now this important point. When you find markets are trading in a tight band of VIX 10 to 15 or within 5 points range for at least 5 months and markets having risen sharply in the last few months, then it is time for the markets to take a reversal immediately or after sharp rise till the VIX rises by at least 8 points from the bottom on weekly chart. Right up. So let's see in this tight band of 5 points since how long the VIX has been trading. The VIX. So what has been the peak here? It has been 23. So we can't count that. So let's see 6 months. This has been 20. This has been 20. This is 15. So 15 means I can take till 20. From here is where I can take. Yeah. So October month. October, November. Only 2 months have passed by. If I take the tight band of 5 points, it has been only 2 months. Or maybe rather than that previous peak that we are seeing, if we consider this as a peak September, then September, October, so this end of September, so October, November, December, January, February, maybe these 5 months, and the fall may come in the month of February or maybe March. All right. So according to this tight band of 5 points, it has only been 2 months so far. So maybe the fall may not come in the month of December, maybe we may get it in the month of February. That is why it is better to buy safe stocks, and then in case any kind of market falls, then you can average those stocks. And it may also happen like this, that market from 18,400 may go to 19,500, 600, and from there we may fall. This is also a probability. In fact, this probability looks higher in case the public is also expecting a fall. Remember one point what I am telling you right now. Very, very important notes. I am sure you also might have heard this news that the entire public and media is cautious, expecting short-term recession in America. That is why it is likely markets may rise sharply to 19,500 even. Before big fall can be anticipated. That's why don't wait to buy the stocks. Buy fundamentally strong companies, we are safe on both the sides. Or you buy 50%, and in case fall comes, then you buy remaining 50%. But if you ask me what is my position right now, entire money is into stocks, portfolio stocks. But yes, if this scenario is built up, I will be pulling out at least 50% of the money, which I am expecting this to happen. Psychology, human psychology is very, very important. I've taken all my trades based on human psychology with the back tested data. So when both of these things match, then I'm being confident on my position. So right now, because I've myself observed it in the last few days, that whomever that I meet, first of all, I've got a lot of calls from the students themselves, a lot of calls even from the IFL clients whose accounts I'm managing. They're all saying one thing: sir, please book profit in our portfolio because there is going to be recession in America. 1% says it, 2% says it, 5% says it. At least 10 people have told me this right now. At least 10 people have told me that they are very fearful that the markets may fall because of recession in America, which may come any time. And if that is the case, then market is likely to surprise you, because market does exactly opposite of what public thinks, and public is thinking already that the markets will fall because of recession in America. So maybe that December month may not be for that market fall, because then the public will go right, isn't it? So big fall may likely come in the month of February. Maybe by December we will reach here. Maybe by January we'll reach here. Maybe by February we'll reach here, and the fall will come in the month of March. But yes, likely a fall will come before March is what I'm expecting. So this is my personal opinion, okay? The entire public and media is cautious, expecting short-term recession in America. That is why it is likely that the market may rise sharply on Nifty before big fall can be anticipated before by March 23, 2023. Let's see what happens. But right now, I would suggest you not to worry. At least for the month of November, need not worry. We'll see how things are setting up for December month. See, small falls like 200, 300, 500 points is okay. That is only 3%. 3%, 5% falls are very normal in the market. What I'm talking about is beyond 10%. At least 2000 points fall on Nifty is what I'm talking about. Alright? Very, see, every word that I'm giving today is very, very important, guys. Very important session, today's session. And I please want you to read these notes time and again. I would consider my training would be successful when I start getting suggestions from you. Rather than I telling you, you have to give your opinion to my personal WhatsApp message. So please get out of the market. Market looks dangerous for the next few days. When I get that data and when I really see that happening, then I would say that my training has been successful. And you would be very soon among that particular person who would have made extraordinary income from the markets, for sure. This has all been the historical data. So when you are free, try to read that. There's no point in discussing each of the scenario. Descending and consolidating wicks in a narrow band 10 to 15 or 5 points band. Wicks occurs every 1 to 2 years and the market is likely to correct post this. Buy puts of 6 months forward contract when wicks is cheaper, and if correction sets in within the 6 months and the wicks also moves up by nearly 8 points, sell OTM, put 6 months forward contract to minimize the costing. In case the market rises sharply with wicks, then deploy bear put strategy with 1:5 risk reward ratio in the 6 months forward contracts as the premium is high. So what all this means is, I told you, on index we can trade beyond 3 months. See here, we can trade even beyond 3 years. In America till 10 years you can trade, okay. See, these are all the contracts we have for the index. Even 2026 is here. Okay, are you able to see that? Likewise 2023 December. See this? Alright, interesting data. So imagine 18,000 call, you are selling it at 1900 rupees of December 2023. It means that till 20,000 on Nifty you do not have loss. Till 20,000 on Nifty you are not in loss. Isn't it amazing? And if I consider 20,000 for December 2024, then till 21,700 you would not be in loss. Okay, these things are going to be very useful for us because tomorrow we will be creating a hedge strategy of 6 months forward contract when we feel that the markets may crash. Alright, that will be discussing in tomorrow's class. Again, tomorrow's class is going to be interesting to see out of calendar, near months, out of calendar options. That is all for today. It's already 9. So any doubts or questions, you may use the chat window and the audio control.